All right. Hello, everyone. Welcome to our third class, believe it or not. Okay, this is the third class and it's going strong. All right, today information is very detailed. I'm going to go over a couple laws and give you some example and talk about in detail of those laws, okay, and how it applies. Last class, I'm talking about the test, and I think I have some information that I need to be corrected. Okay, Trung last time he asked about how long can we still using the class before we taking the test. Okay, so let's say that you pass a class, you get a certificate. How long can you wait before before it's expire, and you need to take the test before that time. And we looked at the one of the test guideline, and we found out that for California, or I think like almost like everywhere, that it will expire like 5 years. Okay, so let's say you pass the class and you don't take a test right away, you still have 5 years to go. Okay, and when you take a test, you just need to review the material, and if you decided you're gonna take the test, right, gotta take it before the 5th year. Okay, or within the 5th year. I'm sorry. Okay, but before we go any further, let me make a couple updates into the last slide. Okay, and then I will post all the slide up here for everybody to take. Okay, let me share. Okay, so I make an update to this slide for class number 2, kind of including the bank here, just to be complete, that the account executive and underwriter are talking to the bank or the lender. Okay, lender could be any investor, like kind of lender. Okay, so that's one change. And the second change was this one. Okay, the course test. Okay, so there are actually 120 questions, and 5 questions that that you answer will be scored. Okay, so they only score 115 questions. Okay, but you have to do all 120. Okay, and also 88 correct equate to 75% to pass the test. And to prepare for the test, you need to study between 20 and 60 hours. Okay, and the test length is about 190 minutes. Okay, like a little roughly about 3 hours and 10 minutes, but you need to be there like about 225 minutes. I'm sorry. Okay, like almost 4 hours. Okay, that way they prep you, they ask you to read a couple policy before you take a test.
I have
Okay, and
questions.
yes.
Oh, you mean like we just miss like just only 5 questions if we don't do it right?
No, you're gonna answer 120 questions. Okay, and within those 120 questions, right, they randomly pick 5 questions that they don't grade. Okay, and they use the answer for those questions to prepare the next set of tests. Okay, so if there are like 100 people taking the test, right, they may get like 500 questions. Okay, a random question. So they use those questions, and they're probably going to grade it, and then probably just pick the one that's correct, right? And then they use that for create like a new test. Okay, so even though that you answer 120, they only grade you 115. They're going to subtract those 5 questions, randomly pick 5 questions out. Okay, or some or maybe some question that they already allocated. Okay, whatever you answer, they don't count. Okay. Okay, so the cost for the test is about 110, and if you fail the first class, the first test, I think like you have to wait. I don't remember exactly, for 3 days maybe, or 7 days, and then if you fail the second time, you wait for a month, you fail the third time, you have to wait for 90 days. Okay, but I think I'll go over that later in this class. Okay, so this is a second change that I make to this slide deck, and I will drop that into the chat so that you can download it. And some of you probably missed the first class, so I will drop all 3 slide decks in here. Okay, just wait for me a bit. Okay, so I'm dropping all 3 files in here. Okay, you can use the third file for today class. Okay, and we're gonna have another class tomorrow, and then I'm probably gonna skip a week, and we're gonna come back, right after January, and hopefully we're gonna finish it, within the first week of January. Okay, so those are the 3 files. Download it. Now let's continue. Okay, so for today class, we're gonna talk about a couple of law. Okay, screen mode. Okay, so you see my screen?
Not yet anh mà.
Or not yet, huh? Không có thấy hả?
Yeah, just see your face.
Oh, that's okay. Okay, let me share. Oh, probably I'm not sharing. I'm sorry. So sorry. Okay, so I got that. How about now? Can you see now?
Yeah, we see now.
Okay.
And we have not received the slide deck on the chat.
Should be in there. Should it? Let me see chat. Oh, I'm sorry. I actually only sent it to Phúc. For some reason, I got direct message with Phúc, but not everybody. Okay, meeting group chat, everybody. Okay. Okay, let me drop the file again. My bad. Okay. My bad. Okay. So let me know if you receive it.
So where
Okay,
can
got
we
it? Okay.
upload the note or the slideshow from
Nice, huh?
the Zoom?
What happened?
So where can we download the note or the slideshow, like as you talking right now?
The slide deck is I just drop it in the chat. If you open up the chat window, and it should be in there. See it?
Oh, okay.
There's a toolbar. Yeah, that's a toolbar for the chat.
So we need to download all of that.
Yeah, I think you missed the last 2 classes, right? So download all 3, and then use the third slide deck for today. Okay. So, okay, so now we're gonna go with class number 3. Okay, so I make an update to this landscape here, the real estate landscape. So that including the bank, the account executive, the underwriter, the people that associate with the bank, the lender. Okay, to help and support the loan officer. Okay. Anywhere that you see that I have a dot, meaning that there's some minimal interaction between that character and another character, meaning in this case it's a TC, a transaction coordinator, helping the real estate agent and the loan officer. So they don't have a lot of interaction, but the solid line are the one that have constant interaction during the transaction or during the escrow. Okay. Okay, before I go on, have everybody try to register the NMLS ID and also register the class. This class that I'm teaching right now is mainly a mentoring class. It's not a class that will give you a certificate to go and take a test. So you have to participate in an online school to get the hours that you need before you can get the certificate and take a test. I will send you I will send you the link to the previous 2 classes that I have a video got recorded. It's about an hour long. So take a look at those videos. The first one should be the one that I'm teaching you how to register for the NMLS, as well as how to register for an online class. Okay. So these are some of the law and regulations that get involved while you do the mortgage lending. Okay. So today I'm going to talk about Fair Housing Act. Okay, so and Fair Housing Act, the acronym. Okay, you need to know the act name, the law name, and you need to know the acronym. Okay, because often in time they only refer to the acronym. Acronym are the shortened version of the name. For example, Fair Housing Act is the acronym is FHA. Okay, and then you also need to know when was this act introduced, right? For FHA, it's 1968. So in this in this slide here, you probably you see that the FHA, right? But we also heard about the FHA program, right? Remember, they have the same name, but they actually different depending on what context that you use it in. So here, the Fair Housing Act is called FHA, but there is a loan product called FHA. Okay, FHA is a loan program provided by Fannie Mae and Freddie Mac. Okay, and that loan program is helping the low income, the not so good qualified borrower. So they have like a minimal down payment, like 3% down payment, right? And but their fee is a little bit high. Their requirement is a little bit low. So the FHA that I mentioned in this slide deck is about the act, a Fair Housing Act, but there also a loan product called FHA. Okay, so let's continue. So what is FHA? Okay, FHA stands for the Fair Housing Act, right? It's the federal law in the U.S. that's prohibited discrimination in the housing related activities, okay, including renting or selling. Okay, so always, okay, the way that you're going to learn to do the test is that always try to associate the act, the name, to what is try to solve. Okay, what is this try to solve the issues, right? So Fair Housing Act. Okay, fair, remember, fair meaning no discrimination. Okay, you have to look at the name and then try to figure it out, because like you're probably not going to be able to remember the description of the act here, right? So try to look at the word, the name, and try to see if you can guess what it is if you don't remember, right? So fair meaning it needs to be fair. There's no discrimination. You treat everybody fairly. Housing, right, is an act that applies to a law, right? Act here is a law that apply to housing, and the law say we have to treat everybody fair, with fairness. Okay, we don't discriminate with anybody, and the FHA law here are focused on what is called is protected classes. Okay, which mean there are 7 classes that this law try to protect. So what are the classes? First, race, regardless of the race. You can be African American, you can be white, you can be Latino, you can be Asian, you can be whatever you are. Okay, this law say that it needs to be fair across all race, color. Okay, whatever the color of your skin is, right? It needs to be fair. National origin, you can be from China, you can be from Taiwan, Vietnam, Philippines, Japan, wherever you came from. Regardless, you cannot discriminate of the origin. Okay, the national origin. Religion, regardless of your religious. Okay, either you Buddhist, Christian, Hindu or whatever, right? You don't discriminate based off the religion. Okay, sex, you don't discriminate if it's like a male or female, transgender or whatever sex the borrower is. Okay, you don't treat the male mostly favor than the female or transgender, right? Or you deny, somebody with, the sex that you don't like, okay? And also family status, okay? You don't treat a divorced person, right? A widower, or, for a woman, let's put it in that case, or somebody as, pregnant, okay? You treat everybody the same, regardless they are married, unmarried, have kid, or or doesn't have kid, okay? And also you don't discriminate disability, right? The person may be on a wheelchair, maybe on a cane or whatever, right? You don't discriminate of that. So these are the 7 protected classes that you don't discriminate, okay? You treat everybody the same, okay? So take a note on that, right? And remember that when you're talking about fair, you have to remember there are 7 classes total, 7 protected classes, okay? And you don't have to name it, because when you take a test, they don't ask you to name it, but they may give like three names in here, and they give you some bogus name, okay? And they say which of this are the are the protected classes, except, okay? So when they ask you except, meaning that you have to pick the one that is not protected, and they may give you something that not in this list, and you pick that answer, which is like a negative answer, right? Something that is not included, okay? So the FHA also prohibited activities. It says it's illegal to discriminate in a various housing related activity, including renting, selling houses, applying for a mortgage, advertising for housing, setting term and condition for housing transactions, including rate, APR, the term, and all the payments and stuff, okay? So all the activity need to be legal, okay? You don't like set this person at a higher rate and the other person at the lower rate if they have the same criteria, okay? If they have the same financial situation and everything, including credit score, okay? So it's prohibited that you don't do illegal stuff when you're helping with the housing related activities, okay? Reasonable accommodation and modification, okay? So this act requires housing provider to make reasonable accommodations and allow reasonable modification to ensure the individuals with disabilities have equal access to the housing, okay? For example, this might include allowing a service animal or making structural changes to accommodate a wheelchair. So for example, right, if you have, so let's say if you are hosting an Airbnb, right? You have a house that you rent out for Airbnb, right? You cannot deny somebody to book your Airbnb because that person has an animal, especially a service animal, okay? I'm in this business, I know, and I believe there are some people out there that try to fishing, hosting like us. Like sometimes they request, okay, we want to book this, but we have a service animal. Can you do you allow that, right? If I say no, right, they recorded it, right? They text me. If I say no, they're gonna come back and they're gonna sue me. But when I say yes, they don't book my Airbnb. It's happened like several times already. Okay, so I have to be really careful when I rent out my Airbnb, because like people are trying to sue you, right? They set you up and they sue you, right? So that's one thing. And also like, people on a wheelchair, right? My Airbnb or even any house, right? You may have a step, at least one step from the street level to the house, right? But you don't build a ramp because ask your family, you don't have anybody that needs a ramp. But if for some reason you rent it out to a family, like a long-term lease or long-term renting, right? And it's happened that you rent it out to a family with somebody on a wheelchair, then they may demand you to build a ramp, and you have to build a ramp. If you don't, you discriminate them, and they're gonna sue you. Okay, so be careful on that, right? You need to understand all the fair housing activities, so that when you get involved with the real estate, right? Get involved with the lending, the mortgage industry and stuff like that, you won't fall for the trap. You won't like treat people differently. Okay, so this act also say that you need to make a reasonable accommodation and modification. Okay, if they have a service dog, you have to accommodate that. If they have if they live in your house, because Airbnb is like a nightly, right? They come and they go. Doesn't mean that we're gonna build the ramp for them permanently, right? And maybe 90% of the visitor they don't have a wheelchair, right? But if they request for it, then maybe you have to do something about it. Otherwise, you're gonna fall into the category of discrimination. Okay, exemption. So this act is actually protect a lot of different classes. It's protect a lot of different people, but there's some exemption to that. There are certain people that this act won't protect. They won't protect, but there's some other class that actually got protected by a different act, a different law. Okay, but let's say this FHA Act won't protect. Okay, exemption like this. There are certain exemptions for specific types of housing, such as a single-family homes rented or sold by an individual who owns 3 or fewer family homes and does not discriminatory advertising or practices. So it's mean that if you have a rental property, and also you buy and sell rental property, so meaning that you're an investor, right? And you keep buying, acquiring property for rent and for sale and all that, and you actually own more than several homes. Okay, then this act won't protect you. Okay, and I have a couple more down in the next few slides. I will explain to that. Okay, so in addition, the enforcement, this act will enforce by the U.S. Department of Housing and Urban Development, short for HUD. Okay, remember this: Department of Housing and Urban Development, HUD. Okay, HUD is an entity, is an agency that enforces pretty much all the real estate law. Okay, including the FHA. So enforcement can be enforced by HUD or get enforced by lawsuits. Okay, so the example I gave it to you earlier, right? If you don't allow the service dog, because like sometimes when somebody asks me that, and now I know that they try to set me up, right? I'm gonna ask, okay, we allow the service dog, but you need to provide a document. You have to provide a document that your dog is a service dog. Okay, and when I answer that, then they just disappear. They don't come back and book my my Airbnb. So I know people out there will try to set you up using these laws, and they're gonna sue you. Okay, so make sure you understand all these laws. If you don't, then just have to come back and do some research about it. Okay. So individuals who believe they have experienced housing discrimination can file complaints with HUD or take legal action with federal or state courts. Okay, so HUD will enforce it if somebody believes that they got violated by somebody, a landlord, an owner. Okay, they're gonna complain with HUD, and HUD gonna step in, investigate, and enforce and fine. Okay, the fine could be money or prison time. Okay, really really important. Okay, next one, state and local laws. Okay, besides the federal law, right? Many state and local community also have their own fair housing laws. Okay, for example, let's say the Los Angeles, right? They have the tenants law that you cannot evict the tenant unless you have a good reason for it. So for landlord, they have a really tough time in Los Angeles city, right? And almost like throughout California, there are cities that have a lot of covenant, have a lot of law that locally protecting the people in that area. Okay, so now once the pandemic hit, you now cannot kick anybody out unless you have a just cause rights. meaning that, okay, what is your reason to take the home back and kick this family out? Okay, in the pandemic, right, they have a law in place that you cannot kick anybody out regardless of their issues. They don't pay you, you cannot kick them out. Okay, they violating anything, you cannot kick them out. But when that's expire, right, and now they have additional law in place and say, if you want to kick them out, first you have to pay for their relocation, at least a month rent of relocation. Okay, and now you have to have a good reason. Are you going to move back in? Are you going to renovate entire house? Okay, what is the reason that you want to take the house back? Like, you just cannot say, or you can say that I'm selling the house. Okay, but you cannot say that I just want to take the house back. It's my house, I want to take it back. No, right? So state and local laws is also protecting the consumer, the renter, the tenants, the buyers, and all that. Okay. Public education and outreach. The HUD set up like a lot of programs to educate the public, right? So that they understand all these laws and all the things that protect them, okay? Including the housing rights and the responsibility, okay? So this act have like several items that allocate, that make sure that everybody treat fairly, okay? So, just continuing. So like I say, FHA prohibited discrimination, and it's protect the seven personal characteristics, right? I already named them: race, color, religion, sex, disability, family status, and national origin. Okay. So there are other laws, okay, like ECOA. Okay, we're gonna talk about that in the next class. But ECOA doesn't including disability in their act, but the FHA does. So FHA protect the the person with disability, right? ECOA is Equal Credit Opportunity Act, right? And that act doesn't mention about protecting the disability. Okay, it just doesn't mention. It doesn't say it doesn't protect. It just doesn't mention that it will protect the disability. Okay. So the FHA cover most of housing in a very limited circumstances. The act exempt. Okay, this is a little bit more detail about the exempts or the thing that the act won't protect, including owner occupied buildings with no more than 4 units. Okay, single family houses sold or rent by the owner without an agent. Okay, so if you are for sale by owner, this act won't help you. Okay, this act won't protect you. Okay, it means that this act won't protect you. Let's say if let's see, let me see how to put this way. Single family house. Okay, because like sometimes there is a structure, there is a home that's dedicated to a certain religious. Okay, so the owner say that I'm going to sell this to this religious group. Okay, so this act won't get affected by that decision. Okay, so that is one of the exemption. Okay, housing operated by religious organization. Okay, that's what I just said. Private clubs that limit the occupancy to the members. Okay, so meaning that let me see here. Okay, so meaning that if they have a club, right, and they only sell to the member of the club. Okay, and they don't sell like widely to everybody, for example. Okay, so in mortgage lending, it is illegal to discriminate under the Fair Lending. Okay, so Fair Lending Act is another act within the mortgage. And also they call about the fair lending is like about disparate treatment or disparate impact. And I will go under detail on these two in the next few classes. Okay, both the disparate impact and disparate treatment refer to discriminatory practices. Okay, and some of the exemption is that certain area, right, doesn't allow anybody younger than 55 years old to live in there and they call that community is a senior community, you gotta be 55 years old or older in order to live in that community. So this right here is violating about the age, right? So, but they say, they dedicated that area. So this is like an exemption, right? They dedicate that area for just only senior, right? So that the senior buying that property, at a lower price, okay? And they may get a better rate too, okay? And also like a reverse mortgage, okay? Anybody have any questions so far? Okay, so like so far I've been explaining about the FHA, okay? What is covered, what is tried to protect, okay? And also there's some exemption to that. Okay, then why there's an FHA, right? When you see an act, right, introduced, imposed, then there gotta be a reason for it. Okay, somebody did something going on that causing that act to introduce, right? So FHA was introduced to address a specific set of challenges in the housing market in the U.S. During the Great Depression and its aftermath. Okay, the FHA was introduced in response to the housing crisis by make homeownership accessible by offering affordable mortgages. Okay, good mortgage program, good loan program, good rate, and all that. Reduce the mortgage fraud, or actually reduce the mortgage default rates by providing insurance to lenders. Okay, stimulate the housing market and create jobs. Set the housing construction and safety standards. Okay, promote home ownership among lower and middle income Americans. Okay, so that's why they create this act in 1968. Okay, we just done one act. Now let's talk about the next act. Okay, and remember, every law, every act is about protecting the consumer. Okay, and make sure it's fair to everybody. It's easy, for everybody to obtain housing, so that they can, can be an owner of a property. Okay, so the next one is a Truth in Lending Act. Truth in Lending Act is short for TILA, also introduced in 1968, and it's called Reg Z, Regulation Z. Okay, so what is TILA? TILA is a federal law in the U.S. that requires lenders to provide clear and transparent information about the terms and costs of consumer credit, such as loan and credit card. So meaning that truth in lending, truth, right? When you talk about truth, that it need to be transparent. Everybody needs to know what it is, right? If you market a product to somebody, that somebody needs to understand what is your product that you try to sell to him or her, right? So meaning that you need to disclose the APR disclosure. Okay, Truth in Lending Act, a lot of this, meaning that you need to disclose, you need to tell, you need to show, you need to make somebody aware of. Okay, so that's what it's called truth in lending. Okay, so you need to tell the borrower the APR, which is stand for annual percentage rate, right? You need to disclose that. If your APR is if the rate is 5% and your APR is 5.25, then you need to disclose that the APR is 5.25. And then further in the closing an estimate, you can say, okay, why there's a 0.25? Okay, these are all the items that it's cost you, in your loan for 0.25. And that you need to explain that. Okay, so lenders must disclose the annual percentage rate, which is the APR, which reflects the true cost of borrowing, not only the rate, but the additional cost to borrow this loan. Okay, including interest and certain fees, that what I just mentioned, right? Finance chart disclosure. TILA requires lenders to disclose the total cost of the loan in terms of interest and fees. Okay, the total. Okay, not just a portion of it. Okay, not just the rate, but the total cost. Payment schedule, right? What other payments are? Okay, when is need to be due? Okay, what is the amount? Okay, lender must provide a payment schedule showing the number of payments, their amount, and due dates. Okay, right of rescission, meaning that you have the right to back out before you sign up for a loan. Okay, that's what it means. Right of rescission. You have a chance, back out. Okay, but there's an exception to that too. Okay, for certain types of loans, not all loans, only certain type of loans, TILA grant borrower the right to cancel the loan within a specific time frame after signing the agreement. So mainly that when you sign agreement, sign the loan doc, that is when you say that I commit, right? I want to borrow the money to do something, either to purchase or refinance. Okay, but the right of rescission majority of the time is when you refinance, right? You say, okay, I want to refinance from 5.0 to 4.5. I agree, or I can do a refi cash out. I take money out, right? And you sign the document. You still have another 3 days to back out and to say, oh, I don't like it. I don't want to move forward. Even though I already signed the document, but now I decide that I don't want to. I have a change of heart. I don't want to move forward. So I have the right to cancel that. Okay. And usually the lender, once you sign it, they won't record it until that those days pass. And then they go and they record. Otherwise, when the buyer decides that, hey, I want to back out, they let the buyer back out and they cancel everything. Okay. But majority of the time, this applies to refinance. Okay. Advertising rule. TILA is really harsh on how you advertise the loan product. Okay, TILA regulate how lenders can advertise their credit terms, ensuring that the advertisement are not deceptive and misleading. Meaning that your advertisement, your little marketing material, won't, bait and switch. Okay, you say something and then you give it, the buyer something else, right? Or you say something that's untrue. Right? You say you have a 5.0 interest rate, but you don't have that rate. You have a 5.5, 5.75, or 6.0, right? And then you only market the product that you have. You don't wildly market somebody else's product that you don't have. Okay? So meaning that if you're looking for a broker, you're looking for lenders, that lender have that particular loan product, you only market that product. You don't market something that non-existent. Okay? So, and like I say, when you, there's a trigger term, okay? When you use anything as a number, APR, rate, 30 years, low down payment. As a low down payment, it's okay. But if you say like, 2,500 payment, okay? Then you have to include the APR in it, okay? And need to be clearly, the font size need to be equal. You cannot have the APR big. You have other stuff like really, little. They don't like that. Right? Everything needs to be, obvious. Okay. So TILA also protecting in the billing errors resolution. The law outlines procedures for addressing and resolving billing errors on credit accounts. Okay, if you make an error, you have to go back and check, right? You have to, keep, looking at your booking and make sure all the numbers are correct. If you identify something that is correct, you have to correct it. You have to notify the part, that associated party. Okay. The main thing in Truth in Lending Act, not beside the APR, is the ability to repay. That is one of the big things. Can the borrower repay the loan? Do they qualify each month with the current employment, with the current credit and everything, right? With the low debt and all that, right now they have the ability to repay. We cannot, foresee in the future of that borrower, but at this moment we have to say, look at their, their statement, their paperwork. Can he or she has the ability to repay? And remember this word because it's in the test. Okay, what is the ability to repay? And which act that mentioned about the ability to repay? Truth in Lending app, TILA. Okay. When you're talking about disclosure and the truth of that how someone is able to get a loan, then everything is related to TILA. Okay. Is this loan have any prepayment penalties? You need to disclose that. Okay, TILA restrict the use of prepayment penalty on certain mortgage loan as well. Okay, so prepayment penalty may have some, with the adjustable interest rate, or some QM, non-QM stuff, right? Or hot money. Okay, hot money probably not in got protected, but there's similar product like that, right? So if there's a prepayment penalty, you have to let the borrower know. Okay, so these are something that cover in the TILA. Okay, so continue, right? The Reg Z or Regulation Z protect people from people when they use consumer credit from predatory lending practices. So back in 2008, they have used a lot of predatory lending practices. Like, okay, I let you borrow regardless of your income, right? I don't have to check your income. I don't have to check the credit. Okay, as long as you show that you have the money in the bank, you have the bank statement that's can show me 3, 6, 12 months, right? Then I'll lend you, right? And they focus on these people so that they can sell the loan product, and that was what happened in 2008. What they call is predatory lending practices. Okay, so Truth in Lending Act say the purpose for this act is to promote the informed use of consumer credit by requiring the disclosure about its term and cost, to ensure that customers are provided with greater and more timely information before they sign anything. They need to have all that information up front on the nature of cost, including the cost of the residential real estate settlement process, right? All the fees, all the costs, everything need to be disclosed. Everything need to be shown up front in a timely manner. Okay, to effect certain changes of the settlement process for residential real estate that will result in more effective advanced disclosure to home buyers and sellers of the settlement costs. Okay, like I say, Reg Z, TILA, introduced a lot of this to promote these items. And Reg Z only protect the asset of residential between 1 to 4 units. Okay, it's protect that asset class. If you have 5 units or more, TILA won't protect you. Okay, so or protect somebody that try to buy that 5 or more units. Okay, so TILA is focused on the consumer credit loans, right, including the mortgage loan, the HELOC. HELOC stands for home equity lines of credit. So some of you in here may question, what is so mortgage loan, right? Mortgage loan is that you go out, you buy a home, you borrow, you take out a loan to borrow some money to buy a home. It's called mortgage loan. But what is HELOC? HELOC is a home equity lines of credit. HELOC meaning that, okay, if you already own a home and the market appreciation in the past few years was great, right? Your home that you purchased $500,000 now worth $700,000. So you have $200,000 in equity, okay? Plus some of the principal that you paid for the last 2 years. So you may have a little over $200,000 in equity. And that is what is called equity, right? So now you go to the bank and you tell the bank, hey, I believe my home has some equity in it. And I know that you have an equity line of credit program that I can borrow, right, from my equity. Okay, not from the total price of the home, but from my equity. So if my equity is 200,000, the bank say, okay, or your paperwork, your income, everything looks good. I'll let you borrow, but you can only borrow 65%, or sometimes 75%. Okay, they don't let you borrow the entire $200,000 in equity. They only allow you to borrow 65%, sometimes 70, sometimes 75%, depend on your credit worthiness. Okay, if you have a lot of good income, you have a good score and all that, they let you borrow higher. Okay, and so that's what it called a home equity line of credit. Okay, reverse mortgages. Reverse mortgages are the baby boomer, right? They have the home, they pay it off probably long ago. Now they owe. They say I don't want to I don't want to pay the bank no more if they still have a mortgage, or they say, okay, I don't want to pay property tax, insurance, and all that, but I want to take out a loan every month from my equity, and I'll take that money and I pay for all my expenses, including food, clothes, transportation, whatever, right? And they take out the money, and then the bank allowed them to do that, right? And then they say, okay, when they pass away, the bank can take their home. Okay, let's say if they take out all the money before they die, right? They can still live in there, right? And until they die, the bank take over the property. That's what called reverse mortgages. Okay, so meaning it's actually a loan that you take out every month, but you don't have to pay back. And because you don't pay back, when you die, the bank take your property. Okay. Open-ended credit, pay as you go. Okay, that's another type of loan. Certain student loan. So you know what student loan is? You go to college, you borrow money to go to college, and then you bought that is a student loan. Installment loans. What is installment loans? Right? Installment pay as you go is like a credit card. Okay, you use a credit card, you pay monthly. If you able to pay the full amount each month, that's good. Otherwise, you can just pay a minimum. When you pay a minimum, your balance gonna keep going up. If you pay it off, then that's good. It will reset. Usually, you don't pay interest each month if you pay it off, right? But if you only pay the minimum, then let's say you owe the bank or the creditor or the credit company $100, right? You pay $50. You still owe them $50. Okay, and then if that credit card may have like a 5% rate on your borrowing, so they will charge you 5% on your $50 that you hasn't paid out off yet, and they add that maybe to 50 cents or 5 cents into that $50. So next month you got maybe $50 50 cents, for example. Okay, and then if you don't pay that, then they just we calculate the total and they apply the rate on that, and then just your balance just keep going up until you pay it off. Okay, or pay it lower. So that's what is called pay as you go. What is installment loans? Installment loans meaning that I go out, I borrow money to buy a car, and every month I borrow 20,000 to buy a hybrid Toyota. Okay, and then every month I'll pay $500. Okay, and I pay for 5 years, 60 months, and that's what is called installment loan. Installment payment $500 for that particular loan. Okay. So truth in lending prohibited acts or practices in connection with high cost mortgages. High cost mortgages are the loan program that have a high cost, a high fees, so many different kind of fees that added up so that your APR is your rate plus the fees. So now your APR is like this high, right? So it's called high cost loan or high cost mortgages. What is included in the high cost mortgages is the high APR, the points, the fees, and the prepayment penalty. All that add up, and it's bring your rate and APR up, right? Your rate gonna stay the same, but your APR is going up this high, and after that, it's gonna stay high up here. You pay every month. Okay, that is what is called high cost, and there is another term called higher price mortgage loan, HPML. Okay, so you need to understand all this stuff. When they say high cost, you understand what is the high cost. High cost means high APR, high point with points and fees and penalty. Okay, and what is high price mortgage loan, HPML? Okay, high price mortgage loan including APR, exceed the certain APOR index. So at APOR index, is there like an index that's set on, let's say the index is set for 5%, but if your APR is 4.9, then it's not considered a high price. Okay, but if your APR is a 5.15, which is higher than the APOR index, which is a 5, then your loan is considered a higher price loan. Okay, so this is more like a category, it's categorized on what type of loan it is. Is it falling under the category of high cost, or is it falling under the category of a higher price? Okay, it could be a higher cost and a higher price loan too, right? Because if your APR is too high and it's higher than the APR, then your loan is high cost, high price. Okay, the APR is stand for average prime offer rate. Okay, so they take all the rate and they average it out and they give you that index. Okay, and that index is a standard. If it's above that index, it's called higher price. Okay, and this APR index issued by the FFIEC weekly, every week. Okay, and the Federal Financial Institution Examination Council, which is the FFIEC, collects and distributes the HMDA information. I forgot what that HMDA stand for. Okay, so high mortgage, something. Okay, so they collect and distribute. I think like they distribute information regarding to this particular index. Okay, so we have to look at what HMDA stand for. Okay, so anybody have any question about this slide? Okay. So continue on the Truth in Lending Act. So TILA requirements do not apply to the following type of loan or credit. So remember, loans and credit. Okay, loans, car loan, property loan. Credit means you borrow credit card. You have different kind of credit, equity, line of credit, whatever. Okay, so credit extended primarily for business, agriculture, or commercial are not included. Okay, TILA do not apply on those type of loan. Okay, or credit. Okay, so remember that. Okay, so TILA, when they ask which type of loan or which type of credit that TILA doesn't apply, right? And you can name it out: business, agriculture, and commercial. Okay, those are the three. What happened if if there's a question, say, okay, which of the following are not covered in Truth in Lending Act, except? Okay, so that question right there is really confusing. First, it's using the not, and second, it's using the except. Okay, so it's a double negative, right? So you have to be careful about the question that when you read certain keyword that you need to pay attention to: except, usually, frequently, not. Okay, because a lot of that is help you to eliminate the answers so that you can pick the right answer. Okay, so pay attention to those kind of questions. Okay, so we talk about the right of rescission, right? Refinance or home equity line of credit, you can rescind after 3 days. Okay, here, granted 3 business days, okay? Not including Saturday, Sunday, or holidays. Okay, if TILA disclosure are inaccurate, are not delivered within 3 years, the bank must return the, and let me see how you run. If TILA disclosure are inaccurate, are not delivered. Okay, if TILA disclosure are inaccurate or not, need to be delivered within 3 years. Okay, within that time frame, right? If you find out that something is not correct, right, you need to, because it's within the 3 years, you have to send a disclosure and correct any billing errors. Okay, we talked about that earlier. The bank must return any money or property given to anyone in connection with the transaction within 20 calendar days. Okay, so let's say you do a refinance or you do a purchase, and there's some money left in the escrow, okay, or in the whole, the total transaction, and then the lender or the bank, when they find out there's some money left, they need to return that money within 20 calendar days. So remember this. If there's a question, say how long does the bank need to return the money if there's some assets money? 5 days, 10 days, 15 days, 20 days. You pick 20. Okay. Right of rescission exception. Okay. You have the right to rescind, but you don't have the right to rescind if you follow, fall into these, loans. First, loans that are obtained for the purpose of purchasing a home. So you cannot rescind after the close of escrow of purchasing a home. Okay. Or after you, you take your loan contingency. Okay. If you back out, right, when you rescind mean that you back out, right? But if you remove all your contingency, I mentioned this in the previous class, right? There are 3 contingency that apply when you purchasing a home, or when you get your offer get accepted. One of which is inspection contingency, appraisal contingency, and loan contingency. So if you remove all those 3, your chance of backing out is 0, or you risk losing your deposit. If you deposit 20K, you lost that 20K, right? If you have those contingency and then you decided you want to back out, the right back out, okay? Then you can take your 20K back, okay? Otherwise, escrow going to give that to the seller, okay? So like I say, with purchasing a home, you cannot rescind. Once you sign the document, once the transfer title transfer is recorded, you're done. Okay. Once the bank fund the loan to purchase a home, the same day the title company will record the title, and that's a done deal. The next day you cannot come back and say, I don't want to purchase no more. Okay, you cannot do that. So purchasing a home is an exception for rescission. Okay, a refinance or consolidation of a home loan with the same creditor. Okay, I mentioned earlier that you can back out when you refinance only if you refinance with a different creditor. You cannot back out when you refinance with the same bank or the same lender. Okay, keep that in mind. There may be a quick a trick question for this, right, in the test. So you have to understand the difference. You can only back out if you refinance. Refinance meaning that you currently have a mortgage with a bank or a lender, and then you refinance with a different bank for a better rate. Okay, and then you can back out if you decide, within 3 days you decide you don't want to move forward. You're gonna stay with your bank. Then you back out, you stay with your bank, your current bank, right? But you cannot back out when you calling up your current bank, say, hey, I wanna refinance, and then when you sign a document and say, no, I don't want to do it anymore. You cannot do that with the same bank or same lender. Okay. Okay, record retention. When you are a loan officer, okay, these are the requirements. The broker of your that where you hang your license with have to follow this guideline. For advertising evidence, you have to keep for 2 years. That's saying, because this is TILA, it's applied to to the loan officer, that when you post on Facebook, when you send out an email, when you print a flyer, those records need to be tracked and keep for 2 years. Okay, because when somebody come back and they say, hey, I saw that ad, it say that I have 5.0 for 30 years, but when I get it in, they give me a 6.0. They point to that advertisement. So whatever you do on the advertisement needs to be correct. Okay, and you have to keep that record for 2 years. But guess what? Nobody do that. Believe it or not, right? How many times you see loan officer throwing advertisement on Facebook, right? They don't even remember. right? Facebook posters like keep rolling and rolling million and million of times. They go into a post and they comment it, they post their ad in there. They don't even know when that, where that post is there anymore. Okay, so at least you have to keep it for 2 years. 3 years record related to loans compensation to MLO. Okay, so meaning that any document, any paperwork related to your commission, your compensation, you need to keep track of that keep it for 3 years. Okay, remember this year and the definition of the retention. Okay, it will be in the test. Okay, what about 5 years? Sales, transfer, or otherwise dispose of an interest in a mortgage loan, closing disclosure. So your CD, when you open an application, right? They got the loan officer, the broker, the lender gonna send you an estimate. Okay, that estimate you can look at it, right? And eventually you can dispose that at the end of the transaction, right? At the end of the escrow or at the end of the loan, processing, they send you a closing disclosure, which is called CD. Okay, this CD you have to retain it, you have to track it, you have to keep it for 5 years. So if the auditor from NMLS or from commissioner came down and then hey, they look at this loan application, they saw your NMLS ID on it, and they track who you are, and they say, okay, I need to see the CD for this loan. You need to be able to show that. Okay, maybe your broker will keep it for you. I hope the broker will have some kind of system to retain all these records. Okay, and they at least keep for 5 years. After that, if they want to keep more, they keep it. If not, they dispose it. Okay, penalty of TILA violation. The fine can be up to 5,000. If there's a question, say, how much fine can TILA fine to an incident? Okay, I say an incident, meaning that there may be multiple incidents. Each incident can be up to $5,000. If you violate 4 times, you probably gonna end up paying 20K of fine money. Okay, and there may be a chance if you do something illegal, you may get in jail for 1 year, or also get fined and then put in jail for 1 year. Remember that this probably going to be on the test. Okay, how long do you get in prison if you violate? What is the penalty? If you violate a TILA, $5,000 per incident, or in prison up to 1 year, or both. Okay, any question? Good stuff, huh? Okay, a little bit more about the Tutoring Lending Act. Okay, some common TILA violation. These are some of the most common violations, including inaccurate APR disclosure. You have to disclose it, and you have to disclose it correctly. Okay, failure to provide loan terms. You give an APR, you give an interest rate, but your marketing, your disclosure, your closing disclosure, your estimate doesn't mention about the correct term. Maybe you calculate on a 30 years, but you apply for the 15 years or 20 years. Okay, missing disclosing statement. You forgot to send out the CD. Okay, that's a violation. Okay, there's some hidden fees. Okay, fee that that you actually injected in, you put it in without the awareness of the buyer or the borrower, right? Hidden fees, then that's a violation. Inadequate advertising disclosure. So meaning you make an advertisement, you give it a rate, you give it 30 years, you give it a payment. But guess what? You forgot the APR. Like I told you earlier, and the trigger term is that anything related to the number, you need to have an APR, annual percentage rate. What is it? Post it on there. You probably sometimes don't need the rate, but you have to have the APR. Okay. Inadequate, I already said that, sorry. Failure to provide right of rescission, meaning that you forget to disclose, you forget to send out a paperwork that, hey, you apply for this refinance, but you have the right to back out, the right of rescission. This is a document. This is a disclosure. I send it to you. Okay, if you don't send that to the borrower, you violate TILA. But guess what? A lot of this is actually provided within the packet, either by your broker or by the lender. Okay, so you have to go through this and make sure that you get a checklist. You check all these items and make sure that you complying with the act. Okay, unlawful prepayment penalties. Okay, you snip in the prepayment penalty. Okay, and the borrower may not even know what it is, but you put it in there. Okay, and the borrower say, okay, I got my loan like 5 months ago. Now I want to refinance, and they didn't know that they have to pay prepayment penalty. Okay, and you didn't disclose that. You didn't include it, right? None of your document or your packet has that in there. Okay, and that is violation. Violation during the mortgage origination, including lender must follow specific procedures during the mortgage origination process, such as assessing the borrower ability to repay, right? I mentioned that. We need to assess and make sure the borrower has the ability to repay the loan, right? If you cannot prove that you have the ability to repay that this borrower has, then you in a violation, right? You just issue a loan, knowing that the person may not be, eligible, may not be, have the ability to repay the money. Okay, a lot of good stuff, right? And maybe this can be in the test too, right? They may pick, you may see like about 9 or 8 of this, 8 or 9 of this, but they may pick 4 of them, and they pick 3 of them, and they sneak in another one, right? Or they can pick 4 of them, and they say, okay, which of these are the most common violation? You have A, inaccurate; B, failure to provide loan terms; C, missing disclosure; and D, all of the above. Which one are you gonna pick? A. Nope, you're wrong. You only read the first one, but you didn't read the next couple one, right? The correct answer is D, because it includes everything. Okay, so when you do the test, you have to be slow. You read everything, all the question, all the answer, and then pick the right answer. Okay, again, why there's a TILA? TILA was introduced to address several key issues and protect consumer in the realm of consumer credit and lending. Because there was lack of transparency, right? The borrower doesn't know anything. Okay, rise in unfair lending practices, right? Predatory lending. Okay, because of that, TILA was introduced, right? Consumer protection, because they want to protect the consumer. So this act was introduced. Promotion of fair credit transaction. They want the mortgage lending, the mortgage industry to be better every year after year, and in the future. So that's why they introduced the TILA, Truth in Lending Act. And also standardize the disclosure. They want, have like the right process, right? Everything needs to be disclosed. Everything needs to be clear, transparent, right? And they, because of issue with billing error, right? They introduced this to correct and show how to correct those issues. And they also mentioned about right to rescission and the legal remedies. Okay, that's why TILA was introduced. Oh my God, 2 law. Okay, a lot of information. Okay, so this law here is an addition to TILA, and what it's called is HOEPA. Okay, so sometimes you have to try to learn how to say this word, right? HOEPA is Home Ownership Equity Protection Act. Okay, introduced in 1994. It's a Regulation Z.
Hi, anh
Yes,
Bấm. Can I ask questions? I have try to record the video you say. Can we record and send the permission to you, like to Zoom?
Là sao em nói hiểu?
Like I want to record this with the screen. Are we able to do that?
I don't think so. I think only the host is can record. Then
Yeah,
I
because
record
it's
and I can
like
send you
permission.
the.
Let me send you the send request. Is it working right now? I'm not sure.
Yeah, it's actually popping up on my side.
Yeah.
Okay, yeah, you can record. You want to record it?
Yeah, but I'm not sure because like look like in my company, we do this one too, and later we can rewatch or
Okay. Like I say,
listen.
I can send you the link to this video too.
Oh, okay, yeah. So later, just to
Yeah,
make
no,
sure
so
because a lot
don't
of
worry. Yeah,
information we
yeah,
cannot
it is.
remember.
It is a lot of information. And I already give you the slide deck. What I'm telling you right now is in the slide deck.
Yeah, okay.
Right, but my explanation is not in there. Okay.
Yeah, I know. That's why we need to record your voice too.
Okay. Is my voice a good voice?
Yeah, it's easy
Okay.
to understand. Yeah,
Easy.
thank
Easy
you.
to understand? Okay, I like it. I like it. Okay, so what is HOIPA, right? HOIPA is a federal law in the US that was enacted as an amendment, right? In addition to TILA, okay? HOIPA is designed to provide additional protection, This act gives some more protection to the TILA, okay? To borrowers in a high-cost mortgage transaction, especially those with subprime and predatory lending characteristics. So when you're talking about OIPA, is an addition protection to the TILA and mentioned mainly on the high-cost, high-price loans. Okay, keep that in mind. Okay, OIPA is an addition protection to the TILA and mainly focus on the high price loan. Okay, high price and high cost loan. Okay, so high cost mortgages, what are they? HOIPA primarily apply to the high cost mortgages, right? Like I just said, HOIPA high cost mortgages, which are defined based on the certain thresholds related to the annual percentage rate. You have the rate plus the fee that become an APR, right? And that APR is the APOR that I mentioned earlier, right? We already talking about this earlier, right? These thresholds are designed to identify if the loan is significantly higher cost than a typical mortgage loan, okay? So HOIPA is mainly trying to identify that so that the loan officer can tell the borrower, okay, there's a high risk, to this loan because it's a high cost and high price, okay? Consumer protection, HOIPA include various consumer protection provision, right? Such as restriction on the prepayment penalties, balloon payments, and negative amortization. Okay, what are those? What are these terms? Prepayment penalty, meaning that if you prepay before 1 year, before 2 years, before 3 years, right? What are the costs that you have to pay, right? That need to be identified, that need to be listed out, that need to be disclosed, right? Balloon payment, what is it? Balloon payment meaning that, okay, your loan can be 30 years long, right? Under amortization, I'll explain that, amortization. Meaning that, okay, your loan is based on the 30 years, but after 10 years, you have to pay everything back. They calculate on the 30 years so that your monthly payment is low. They don't calculate at 10 years because if they do that, you're not going to be qualified to borrow it, right? Because your payment may be triple. But if they spread it out to 30 years, your payment is low, but the loan say that you after 10 years, you have to pay it off, or after 5 years, after 7 years, depending on the loan program. Okay, that's what it's called, balloon payment. Balloon payment is a one-time pay after a certain period to pay off the rest of the balance. Okay, negative amortization. Negative amortization meaning that if you pay evenly across monthly over the whole term of, let's say, 30 years, right? And eventually your balance is going to go down, right? However, negative amortization is that regardless what you pay, your balance is going to keep going up. So meaning that what you pay is still less than your interest, less than your principal. And then what's remaining from the interest going to add to the loan. And then next month you pay the same amount, then that's interest again after the loan. And then your loan keep growing, It's never shrinking. It's supposed to be shrink over time, but negative amortization is not. Your loan keeps growing. This also requires enhanced disclosure for high cost loans. So if you have a high cost loan, more disclosure that you have to disclose. Okay, you have to tell more. Okay, what's going on with the loan program. Okay, HOEPA also prohibits several practices, specific lending practices in high-cost mortgages that are considered abusive or predatory, just as loan flipping. Loan flipping, remember this word, loan flipping, meaning frequently refinancing, right? You may have a loan officer say, hey, let's refinance your mortgage, right? The rate is just dropping from 5.25 to 5.0 right now. And then 2 months from now, that same loan officer is going to come back to you and say, hey, let's refinance again. Your rate is dropping from 5.0 to 4.875, right? And then you refinance again. But guess what? You pay fees and costs every time you do refinancing. And that's how the loan officer, that's how the broker make money. Okay, so loan flipping, because if you flip the loan so much, you're changing the loan, you refinance too many times, you lost a lot of fees. And there's a lot of charges that associated with the refinance, right? Charging excessive fee, or meaning that you charge the fees too high. It's supposed to be $500, but somehow your fee was like $750. Okay. And also lending without verifying the borrower ability to prepay. Okay, so those are the prohibited practices of the HOEPA. Okay, additional disclosure. Borrower in a higher cost mortgage transaction receive additional disclosure to help them better understand the terms and risks associated with these loans. Okay, with the high cost mortgage loan, higher APR loan, then you have to disclose more. Okay, the right of rescission. HOEPA provide borrower with the right of rescission for up to 3 days after closing of a high cost mortgage. Okay, and like I say, this is refinance, not purchasing. Okay, during this period, the borrower can cancel the loan without penalty. Okay, enforcement of penalties. Violation of HOEPA can result in legal action against the lenders, including the penalty, damages, and rescission of the loan, meaning cancel the loan, right? They get fined, they get the money back, pay for damages, and then the borrower can cancel the loan. Okay, HOEPA also anti-steering provision. Okay, what does steering mean? Okay, contain an anti-steering provision that discourage lenders from directing borrower into high-cost loan when they may qualify for more affordable alternatives of loans. So HOEPA preventing the lenders from selling a high-cost loan product where that same borrower can get a better, lower cost, right? If the auditor find out that the lender is selling, this this loan, the high cost loan to this borrower A, well, they can prove that this borrower at that time can get a lower rate, lower term, and all that loan, then they violate the anti-steering. Okay. So anti-steering meaning that they don't want the lender to sell a product that higher than the alternative that the borrower can get. Okay, enhanced counseling requirement. Okay, so more resource, more counselor that the borrower can go and talk to if they have questions. So usually the lender will send out a list of a list of counselor that the borrower can go and talk if they desire, if they want to. Okay, if they don't want to, that's fine. Okay, HOEPA also a federally related loan application. The lender must be the lender must it must be an owner occupied. Disclosure requirement for higher cost loan and higher price loan, restrict term on transaction, restrict fees and practices, add additional ability to repay requirement. Okay, so all these need to be met or disclosed. Okay, provide a list of at least 10 housing counselors. So remember, when the borrower borrow in the high cost loan, right, high price loan, you need to provide a list of counselors, right? And if you don't show that, right, you're violating the TILA or HOIPA, act. So I seen this question in the test, right? They say how many housing counselor does the borrower, can the borrower talk to, or does the lender provide it? Okay, 5, 10, 15, 20. Okay, the answer is 10. Okay, list of counselor must be sent at application or within the 3 business day. So let's say, you know, a buyer, right, want to go buy a house, right? The buyer work with an agent to put in an offer, right? The offer get accepted. The buyer talk to the loan officer, say, hey, I just got accepted with this home. I want to open an application to borrow the money. Okay, at that time, usually at the day of the acceptance of the of the offer, or at least 1 day after, right? Then the loan officer, the lender, going to open an application so that the buyer can fill it out. Once the buyer complete that, so within 3 days of receive the application, the lender have to send out an estimate of the loan, as well as certain document regarding to counselor and all that. Okay, and some for the high cost loan, the lender required to do a full appraisal. Appraisal, what does it mean by appraisal? Appraisal meaning that the bank gonna send an appraiser to a house, visually look at the house, and come back with the numbers, working with data in that community, and come up with a price using previous selling home in the area, right? And come up with the price for the purchase home, and that the whole process is called appraisal. Okay, and because this is a high cost loan, this is a HOIPA, it needs to be a full appraisal, not waive appraisal, or not partial appraisal. Okay, so remember that. Okay, for HOIPA, for high cost, high price loan, the full appraisal need to be done. Okay, and escrow account for the first 5 years. Okay, so meaning that for the high cost loan, high price loan, they require an escrow account. The escrow account, what is an escrow account? I talked about the escrow yesterday. Where escrow is a company that helping with the paperwork, but the escrow account is different. Escrow account is an account that the the loan servicer, a company that service the loan, servicer of a loan, meaning that they will take your money and they will pay the lender, they will pay property tax, they will probably also pay for insurance, right? So the escrow account is the account that holding all the money that you put in, so that the servicer going to use that money to pay for all those 3 things that I just mentioned. Okay, and then that escrow account needs to be open for 5 years. Okay, for the high cost, high price loan. So what does that mean? Do I have to keep this escrow account for 5 years? Yes, you do. However, because like you currently have a high cost, high price loan, but you have extra money, you want to refinance, then when you refinance, you put in that extra money, then your new loan may not be a high cost, high price loan anymore. And that time you can close the escrow account, and your loan now going to be a conventional loan, right? And you can get away from the high cost and high price loan. Okay. So what happened if there's a question that said, can you close the escrow account, right? You have to think carefully about this. There's a requirement that this account needs to be open for 5 years. So how can I close, right? The answer is yes, or depending on the answers, right? But I hope if the answer say yes, you can close it if you refi, right? When you refinance, you just close that previous escrow account. Okay, so the high cost loan determination. So how you calculate the high cost loan. Okay, and there are 3 tests that you can do to determine if a loan is a high cost loan. Okay, test number 1, point and fees must not exceed 5%. Okay, for example, $400,000 loan with points and fee of 7,600. Okay, 400,000 loan worth 7,600, right? Fees and points. So you take 400,000, you multiply by 5%, so that is 20% total. So meaning your point and fees cannot greater than 5% or cannot greater than $20,000. But your point and fees now is only 7,600, which is less than 20,000. So it's okay. Okay, so this high cost loan is okay for 7,600 because it doesn't exceed 5%, right? So it's actually, it's actually not a high cost loan, okay, because it's within or below 5%. So this right here is the finance, requires some calculation. So in the test, you may use the calculator to calculate this, right? If they say, okay, there's a loan for 500,000 with the point and fee cannot exceed 5%, is it a high cost loan? If the point and fee is 9,000, right? You use the calculator, you calculate all that, you take the total loan, you multiply by 5% and find the maximum point and fee is allowed before it's become a high cost loan. Okay, and if it's only 9,000, less than 20,000, it's not a high cost loan. Okay, so that is test number 1. Okay, what is the test number 2 to determine the high cost loan? Okay, so the high cost loan is that the rate plus the APR, average prime offer rate, and that need to be less than or equal to the total APR. Okay, so back to the same question. Okay, if there's a loan of 400,000 at the 4.5% rate, and the APR is 7.2%. So if you're looking at this, right, the rate is only 4.5, but the APR is 7.2. If you already subtract that, that's like a big number in between, like almost 3% different. Usually the loan rate and the APR really close together. If you have a rate at 4.5, usually a good loan is only 4, maybe the APR is 5, or maybe 4.875, right? Not like all the way to 7.2. Okay, so with this example, right, $400,000 loan, 4.5 rate, and the APR is 7.2. The APR index is 2.5. So let's find out if this loan is a high cost loan. Okay, so the rate plus the APR, which is 4.5 plus the index of 2.5 equals 7%. And 7% is less than the APR, or the APR that they say 7.2, which is greater than the total rate plus APR. And now, because APR 7.2 is greater than 7, it is a high cost loan. Okay, so this is how you calculate the high cost loan. Okay, 4.5 plus 2.5 equals 7%. The APR 7.2, which is greater than 7%. So this loan with the APR of 7.2 is considered a high cost loan. Okay, so that's test number 2 to see if a loan is a high cost loan or not. Okay, test number 3. Is there any prepayment penalty? Prepayment penalty that more than 36 months after the loan is taken out, or in an amount that exceeds 2% of the amount prepaid, is considered a high cost loan. Usually your prepayment penalty is, like 3 years or less. If it's more than 3 years, it's considered a high cost loan. Or if the amount that you pay for prepayment penalty is more than 2%, then it is a high cost loan. Okay, so those are the 3 tests that you can use to determine if the loan is high cost or not. Okay, is that clear? Question? A lot of good information, right? Okay, let's speed it up a little bit. I think we overrun a little bit here. Okay, so that's the high cost loan. Now, how do we determine for the high price loan? High cost loan is different than the high price loan, right? High cost loan regarding to the APR and that, right? But the high price loan is that 1.5% plus for first lien mortgages below Freddie Mac loan limit. Okay, let's say if San Diego, right? Freddie Mac say the maximum loan that you can get is $750,000. Okay, if your loan is $750,000 or less, it's considered a non-high price loan. But if your loan is greater than 750 plus an additional 1.5% of Freddie Mac, then that can consider a high price loan. Okay, and if it's a 2.5%, more than that, more than the Freddie Mac loan limit, then that is considered a high price loan. Okay, 3.5 for other liens, meaning that not only the first lien but the second lien. Okay, second lien is that sometimes when you purchase a home, you may need two loans to be able to purchase a home. So the first lien is the first mortgage that you may borrow $400,000, and then hey, in order to buy this property, maybe you need additional $50,000. So you borrow a second loan, a second mortgage, or the second lien, right? That is what the second lien means, or other liens mean. So the first lien is the first mortgage, the primary, the biggest, right? The second lien is the lien or the second mortgage that is, additional money that you need to close the property. So it say here, if the second lien or other lien, right, have a 3.5% higher than the Freddie Mac limit, then that's considered a high price loan. Okay, so the equation is the APR plus the high price mortgage loan factor equal the loan threshold, and that need to be lower than the APR. Okay, if that's greater than the APR, then that's considered a high price loan. Okay, some exemption, right? It doesn't take into account construction loan, reverse mortgages, or FHA loan. Okay, agricultural loan as well. Okay, probably this is the next to last slide. Okay, why is HOIPA, right? We know what it is. We know a lot about the HOIPA, but why is there a HOIPA in the first place, right? The Homeownership Equity Protection Act was introduced in response to concerns about predatory lending practices and the need to provide additional protection, right? They introduced the HOIPA to give more protection against the predatory lending concern, against the vulnerable borrower who doesn't know much, right? Again, the lack of transparency, you don't disclose enough, okay? Against the unfair loan terms, right? Lenders like giving an unfair loan term, high price loan, high cost loan, right? So HOIPA is there to protect the consumer, okay? And then HOIPA want to educate the consumer, right? Give the consumer the rescission right to back out, right? And anti-steering. Instead of getting good loan, the lender give you a bad loan, right? HOIPA protect that, right? Don't get get trapped into that kind of loan. And then they enforce it. They fine the lender, they fine the loan officer or whoever got involved, right? And do things illegally. Thank you. A lot of good information, right? So I kind of take a different approach, this time, where I introduced you to the an act, but within that act, I also kind of combine what it does and how is it fit into loan processing, how is it fit into MLO activities, and what are the scenarios, right? What is a good thing? What's a bad thing? What is the act? Why does the act introduce? Right? Who get affected? Right? What is the workaround? Okay, what are condition, what are the fine, what are penalty, all that, right? So I talk like so many different things for a particular act. So that way, when you study, okay, this is act, okay, when it was introduced and what this act does, I think that probably gonna help you, when you're taking a test. Okay, any questions? I know it's too late. 36 minutes over the schedule time. Okay. Anybody have any question?
I have questions. Hello?
Nadia.
For the balloon payment. So I'm not sure for the mortgage loan, but I saw that for the SBA COVID-19, the EIDL loan, it shows like if a client had to pay for 30 years for the, it's called like, look like the business loan. So it means like after 30 years, they have to pay for the total lump sum or what?
Yes, for a lump sum. Yes, whatever the year that they set for you, right? If the whole loan that amortized for 10 years, but they say after 3 years you have to pay the balloon, meaning you have to pay the lump sum. You have to pay the entire remaining amount at that particular year that they set in the agreement. Okay.
So
So
for
if they
example,
say three, go ahead.
like the monthly payment, they pay example right now 2,000 for 500,000 for the loan. After 30 years, they have to pay back for the total lump sum with the interest, or
Yes.
just the
Okay.
remaining balance left.
Yes,
Because
the
I
remaining. Okay. So let's say if they the term for the balloon payment is 5 years, right? So
Yeah.
you're gonna pay from month number 1 all the way to year number 4, month number 11. Okay, and then on the month number 12 or at the 5 years, you have to pay everything. Let's say 4-year, month 11, you pay 2,500 a month, and you still have a balance of 125K. And then at the month 12 of the, or let's say at the first month of the 5th year, right? You gonna, oh, actually, my bad. At the 4th year, month number 12, right? You have to pay 125,000 plus, 1 month interest. So meaning that you're gonna pay the whole thing. So meaning that before that, the end of the 5th year, you need to refinance or you need to pay it off.
Yeah. Have you heard like the COVID-19 loan, they can refinance?
So meaning that you have to find another hot money to pay it out.
Oh.
Well, however you get the money, you open a line of credit, a HELOC, you get the money, you pay it out, right?
Okay.
Yeah. Otherwise, at that time, you gotta pay back that money, or you're gonna be default, right?
Like if we have the mortgage loan in 10 or 15 years, so we have to pay for the lump sum for that.
Yes, you have to pay for a lump sum, the remaining lump sum.
Okay. Yeah.
Okay. Okay. Anybody have any other question? Hopefully, today's session is informative. It's a lot, I know, but I hope my approach this time is gonna explain the act clearly, and all the scenario, all the little details about the act, so that you aware. So when you take a test, right, all these numbers will help you. Okay.
Yep.
Okay, Trung, you have any question?
Yes, I do. Yeah, I'm sorry, it's too late, but I have a question. So you mentioned flipping loan flipping about refinance many times. So you got to take extra cost, right? So I also heard that when you find a house, even though you got to pay a high interest rate, just buy it and then refinance later. But by the time you refinance, you got to pay the refinance fee. Do you think that's a good idea to do that? Do you have any comment on that?
Yes. Okay. So now let's say this borrower or this buyer want to buy a house, right? When they buy a house, they may have specific need for him or her, or their, his or her family, right? So because they can, the thing is that nobody can predict what the market gonna be in the next 6 months or a year or 2 years, right? So now they hope that, okay, I have a need right now, right? My rent is too high. Instead of keep paying the rent, probably I just buy a home and pay myself on the home, right? Using that same payment, right? So the mentality right now is that, okay, I may have a feeling, I heard around, I heard people talk, I heard people chit chat that the rate may drop, okay, but I have a need right now to buy a home. So I just go buy a home right now, and hopefully that within 6 months, 12 months, 18 months, 24 months, the rate gonna drop. Then I'll refi. Okay. So like I say, nobody know what the future holds, right? Fed gonna keep the interest rate high, who knows, right? But they hope the rate gonna drop so that they go out and they buy now, right? And then they're gonna keep it. But when they buy, they probably know that they have the ability to repay, right? Unless they lost a job, or unless if their lifestyle changed, they spend too much, they don't have the ability to pay anymore, right? So meaning that right now, if they believe that they can keep that that payment for the next 6 months, they may reduce their monthly payment when they refi. Okay, maybe if it's not 6 months, they're gonna wait for 12 months, right? But the mentality is that they go out, they buy a home at the current rate, right? And they also scared that when the market, when the rate drop, the home price may go up again, right? Because nobody can guarantee that there will be a housing market going to crash, right? Nobody can assume that. So they say, okay, but fundamentally they think if the rate drop and if the economy is not in the recession, then guess what? The housing market is going to keep going up. And they're afraid if they're going to wait out, and then 6 months from now, instead of buying this home for 700, they may have to buy it for 750 or 800. So they, what the heck? I'll buy it now at the higher rate. Hopefully the rate will drop and I refi. So that's more like a mentality kind of thing.
So it's like a trade-off.
Like a trade-off.
Right. Yeah.
Yep.
So as long as you like it, just buy it. You have to pay
as
more,
long as you have
actually.
a need.
Yeah.
As long as you have a need, and you never know. But majority of the people already in the market, they think investing, buying a real estate is always a good idea, right? Because like you pay the landlord, now you pay yourself, right? It's better, right? And sometimes that the landlord may increase the rent, right? But yours is stable. The payment doesn't increase. As long as you keep your job, even if you find more job, right, more income, and then you can pay it lower, right? Any more questions? Good stuff.
For
Okay.
each chapter, do we have like the quiz to practice?
Right now I don't provide that, but at the end of the class, I will holding like 1 or 2 sessions for practicing all the material, and I'll give you questions to answer. Okay, but right now, if you look at my my first video, right? I suggest that you're going to register an NMLS and then register a class. Okay, an online class at MEC, Mortgage Educator Compliance.com. Okay, you register a class with them. After each video, they have a quiz, a small quiz for you. After each chapter, they have 5 question test, a quiz. And then after the course, they have like 100 question quiz or test, right? So that's how you practice. Okay, and because the loan MLO is only requiring 18 hours, so it's not that much. So I cover everything, then I'll practice with you at the end. Good? Sound good? Okay, so if no more question, I'll see you tomorrow. Okay, tomorrow is the last day I want to hold tomorrow class, and we're gonna come back, after the first of the year. Okay.
Yep. Thank you, anh Mẫn.
you.
Okay, rồi have a
Yeah.
good night.
Good night.
Bye
Yep.
bye.